Life and Disability Playbook. Paul versus Virginia. Insurance is regulated by the states. Southeastern Underwriters Decision. Insurance is regulated by the feds. McCarran-Ferguson Act. Insurance is regulated by both feds and states, and primary regulation is by the states. Insurance Code. State laws regulating insurance that create the Department of Insurance. There are 5 major sections in the California Insurance Code. There are approximately 20 classes of insurance that may be offered to the public. Life, fire, marine, and disability are examples. Annuities are not a class. Insurance Commissioner, Administrator, Superintendent, Director. Elected by the public, allowed 2 4-year terms appointed by the governor. The governor will appoint an interim commissioner in the event the commissioner resigns, dies, or is disabled. Enforces but cannot change laws. Only legislature may change laws. Shall is mandatory. May is permissive. All rates must be filed and approved by the Department of Insurance using the file and use method, also known as prior approval rules. National Association of Insurance Commissioners, or the NAIC. Help to reach conformity between all states. Create model laws for insurance companies to follow. 12 mandatory provisions with regards to individual health policies. 11 optional provisions with regard to individual health policies. 14 Medicare supplement plans may be offered. Definitions and terms. Person. Any legal entity such as a natural person, association, corporation, partnership, business, trust, organization, etc. Natural person. An individual human being. Insurance. A contract. A contract whereby one undertakes to indemnify another against loss, damage, or liability arising from a contingent or unknown event. Indemnity. To restore one to the condition that existed prior to a loss. Insurable interest. Having a legitimate economic or financial interest in the preservation of life or property that is the subject of insurance. In the property and casualty field, it must be proven at the time of application and at the time of loss. Having an unexpected or contingent interest does not constitute insurable interest. In the life and health field, it must be proven only at the time of application. The beneficiary is not required to have insurable interest. The larger the number of similar risks that are combined in a group, the more predictable it will be the future expected losses in a group. Cannot be used to predict individual loss or profits. Loss. Reduction in the quantity, quality, or value of an asset, such as property, liability, or human, not financial. Inside limit. A limit imposed on a specific type of loss within the policy maximum. Risk. Uncertainty of a loss. Pure risk. Possibility of loss only. Speculative risk. Possibility of loss or gain. Methods of risk management. Sharing, which is co-insurance or reinsurance. Transfer, which is to buy insurance. Avoid, which is not to do it, to avoid the risk completely. Reduce, which is to put something in place that reduces the risk, such as build a fence around the pool. Retain, which is to self-insure or have no insurance. Co-insurance deals with sharing in a claim on some percentage, such as 80-20. The insured pays a small percentage after the deductible has been met. Reinsurance, sharing the risk between two insurers. Retention limit is the maximum risk an insurer may handle. To insure in excess of its retention limit, the insurer must reinsure. The original insurer is known as the ceding company or primary insurer. The agreement between the ceding company and the reinsurance company is known as a reinsurance agreement or treaty. A peril is a cause of loss. A hazard is a condition that increases the likelihood of a peril occurring. Physical might be living next to an explosive factory or having badly worn tires on the car. Moral is lying or cheating. Morale is having an indifferent attitude, being a risk taker, driving too fast. Legal is excessive payouts. Transacting insurance. First step, solicitation, which is advertising or marketing. Second step, negotiating, which is having conversations. Next step is execution, where the prospect becomes a client. Next step is transacting of matters after the sale, servicing the policy, adding coverages. It does not include compensation made from the sale. Transacting without a license is a misdemeanor, and it carries up to $50,000 fine and or 1 year in jail. Parts of a contract. Consideration, exchange of value, or an act for a promise. Legal purpose or legal objective, cannot get a gain. Agreement, offer, and acceptance. Competent parties, cannot be a minor or intoxicated. So it spells CLAC, C-L-A-C. Consideration, legal purpose, agreement, competent parties. Entire contract provisions, policy plus application equal the entire contract. Parts of a policy. Spells TICE, T-I-C-E. Title page, insuring agreement, conditions agreement, and exclusions. Title page is the first page of the policy. The insuring agreement describes the type or kind of policy. The conditions agreement spells out obligations for each party. And the exclusions are the exclusions. Parts of an application include number 1, general information, number 2, medical information, and number 3, agent's report. Non-medical application does not mean no medical exam. It may lead to further underwriting. Mortality tables predict the likelihood of death per 1,000. Morbidity tables predict the likelihood of a sickness or disability. Premium factors. Insurance is sold by the unit. 1 unit equals $1,000 of insurance. Mortality or morbidity. Interest plus expenses equals gross income. Mortality, morbidity minus interest is the net premium. Reserves is not a factor. Reserves represent an insurance company's obligation to pay claims. Therefore, reserves are liabilities. Fiduciary, premiums held in a trust. No commingling, embezzling, otherwise it would be theft. Refunds from company equals 25 days. From agent of record equals 15 days. Misrepresentation or twisting is an agent lying, is a misdemeanor, and the fine is $10,000 and or up to 1 year in jail per account. Nolo contendere means guilty, no contest. Concealment, client withholding material information, may be intentional or unintentional, may rescind the contract if it's material. Warranty is a statement of fact, express in writing, implied is not in writing. Representation, best knowledge or belief, a promise, oral or in writing, may qualify as an implied warranty. A representation as to the future is a promise. may be changed before the policy goes into effect, not afterwards. Agrees to its assertions or stipulations. Adhesion is any ambiguity in the contract will be determined in favor of the insured. It's a take it or leave it. Aleatory is based on uncertain events, unequal distribution. Personal contract is a two-party contract. Unilateral is one-sided. Only the insurer must live up to their end of the contract. Utmost good faith. Rely on the representation of either party without any attempts to conceal or deceive. They trust each other. Waiver. Voluntary or intentional giving up of a known right. Estoppel. Once you give up a right, you don't get it back. Domicile of an insurer. Domestic. Originated in California. Foreign. Originated out of the state. Alien. Organized or originated out of the country. Admitted. Company has a certificate of authority from each state to actively sell in that state. Non-admitted. Company does not have a certificate of authority. Insurance companies. Stock insurer. Insurance company that raises capital by selling stocks. Sells non-participating policies. Owned by shareholders who may receive dividends. Stock insurance company, non-participating policies. Policyholders pay after-tax premium. Taxable dividends are paid to stockholders. Mutual insurers. Raise capital by selling participating policies. Owned by policyholders and may receive non-taxable dividends, defined as a return of excess premium paid. Demutualization is when a mutual insurance company converts into a stock insurance company. Mutual insurance company participating policies. Policy holders pay after-tax premium. Non-taxable dividends are paid to policy holders. Reciprocal insurer, inter-insurance exchange, is an unincorporated attorney in fact. Fraternal insurer, charitable or benevolent activities. Captive insurer, parent company owns smaller companies that cover parent company's obligations. Lloyd's of London, provides insurance but is not an insurance company. Provides a physical location for buyers and sellers to insure each other's risks. Syndicates provide insurance coverages. Solvency of an insured insurance company. To be solvent, an insurance company must have enough paid-in capital, surplus, and reserves. Insolvency. An insurance company becomes financially impaired, such as only having enough to cover its outstanding liabilities, including reinsurance. If an insurance company may be in an impaired financial condition, the Department of Insurance will step in and try to salvage the company with or without court approval. Summary seizure is working to salvage a company without court approval. Conservation is taking over a company to get them on their feet with court approval. Liquidation can only be done with court approval. The commissioner will also contact the Insurance Guarantee Association. Life and Health Insurance Guarantee Association protects policyholders in the event that their insurer goes insolvent. Every admitted insurer is required to be a member and pay dues into the association. It's run by a board of directors. You cannot use the existence of the Guarantee Association as an inducement for the sale of an insurance product. The parts of the insurance company are actuarial, claims, marketing and sales, underwriting, and adverse selection. Actuarial is responsible for keeping the insurance company financially sound or stable. Claims investigates and settles claims. Every insurer must maintain a unit or division to investigate possible fraud by its insureds. Marketing and sales is self-explanatory. Underwriting is the process of selection, classification, and rating of risks. Adverse selection, high-risk people trying to seek out and get coverage more often than normal risk. Licenses and related topics. Insurance agent is a person who represents or sells on behalf of an insurance company and gets paid commissions. They must be appointed. They can transact all types of coverage except life or disability. Insurance broker is a person who represents the client or another person who secures coverage with but not on behalf of the insurance company, charges a fee. Posts a $10,000 bond, can transact all types of coverages except life and or disability. Insurance agent. Well, under insurance agent, you would have insurance company, insurance agent, client. Insurance agents are appointed by the company and are paid commission for policies sold. Under insurance broker, you would have insurance company, insurance broker, client. Insurance brokers represent the client to a company. They post a $10,000 bond would be an example. Insurance solicitor, natural person appointed by one broker or agent, can transact all types of insurance except life and or disability. Personal lines license, limited personal lines sales only. Life agent, a person who represents the company, paid commissions, sells life and or disability. So under life agent, you would have the insurance company, the life agent, the client. Life agents transact life and or disability. Life and disability insurance analyst is a fee-based consultant. Must be knowledgeable about life and disability insurance, reviews a client's insurance expenses and investments, and tells them what kind and how much insurance to get, and charges a fee for the advice based on a written agreement. Administrator or third party. Administrator's services only contract. Has a contract with one or more insurers to collect premiums and pays claims to residents in the states with regard to life, annuities, and disability coverage. It must have a certificate of registration of administrator, typically used for self-funded plans. Managing general agent. Hires, trains, and fires agents. Must have an agreement with an insurance company. Collects premiums from producing agents. Surplus lines broker. Represents non-admitted companies. Must post a $50,000 bond. Special lines surplus lines broker. Represents non-admitted insurers and posts a $5,000 bond. Exclusive licenses. Bail, title, mortgage guarantee. If you're licensed to sell any of these three, that is the only thing you can sell. Example, bail bonds licensees may only sell bail bonds. Binder, unconditional receipt for initial payment, good for 90 days, usually 30 to 45. Only agents may bind. Never used in life or disability. Covering note, conditional receipt. Conditional receipt for initial payment, good for 90 days. May be extended 60 days for a total of 150 days. Tort, a legal wrong other than a crime or breach of contract. Crime is criminal law. Breach of contract is contract law. Negligence makes up the largest area of tort law. Negligence is a fail to do what a reasonable and prudent person would do. Absolute liability, the ability to compensate without regard or fault or negligence. Assumption of risk, a situation in which you know the risks involved, yet you still want to engage in the high-risk activity. Life insurance products. Fixed products, general account, would include term life, whole life, universal life, and equity-indexed universal life. Variable products in separate accounts would include variable life and variable universal life. Term life would include pure death protection, coverage for a fixed period of time, could be 1 year, 5 years, 10 years, 20 years, or 30 years. Death benefit may be level, decreasing, or increasing. Premiums are level during the term and increase on renewal. They have no cash value. They're initially inexpensive. They may be renewable and or convertible. Whole life. Coverage for the whole life fixed premium. So they have coverage for the whole life. They have a fixed level premium. They have a level death benefit. The cash value earns a fixed interest rate, and the cash value is invested in the general account. They have coverage to age 100, at which time the cash value has grown to the total death benefit. Universal life has a flexible premium that are paid directly into the cash value. Has mortality and expenses that are deducted from the cash value. Excess interest is credited into the cash value. Cash value earns the current interest rate with a guaranteed minimum interest rate. They have a level or increasing death benefit. The cash value is invested in the general account. So they have a level death benefit. Their net insurance decreases as the cash value grows at the current rate of interest with a guaranteed minimum rate. And they have a flexible premium. Equity indexed universal life and indexed universal life. They have flexible premiums, level or increasing death benefit. Cash value realizes a particular stock market index such as S&P with a guaranteed minimum rate. So the net insurance decreases as the cash value grows using an indexed crediting strategy with a guaranteed minimum rate. Variable life or variable universal life has scheduled or flexible premiums, level or increasing death benefit. Cash value is invested in the separate account, which then realizes stock market returns. Client chooses the investment in the cash value. No guaranteed minimum return. Illustrations cannot use more than 12% to show possible growth. So the net insurance decreases as the cash value grows at a market rate of return with no guaranteed minimum rate. A graded premium step rate policy has convertible term with preset conversion built in annually increasing premium for the period of time, and then level premiums thereafter. Modified life has a convertible term with a preset conversion date. It converts into a whole life policy. Low premiums for 5 to 7 years, then higher premiums after. Adjustable life. Face amount may be adjusted based on money purchase concept. Jumping juvenile policy. A small face amount whole life policy on the child. Normal face amount jumps 5 times the original amount at the majority age, usually 21 to 25. No medical exam or premium increase on the jump. Joint life first to die. Joint equals married couples. Face amounts are 1 million or more. They're based on the first to die. Designed for estate preservation. Survivorship, second to die. Cheaper than individual policies, based on second to die. Doesn't pay on the death of the first to die. Pays after both die. Family protection policy. Whole life on the breadwinner and term riders for the family members. Family income policy. Only on the breadwinner, and it's a whole life with a decreasing term rider. Family maintenance policy is only on the breadwinner, whole life, and a level term. Costs slightly more than the family income policy. Mortgage redemption protection has a decreasing term. Non-forfeiture options. Dropping your permanent policy and using the cash value to do one of the following. Cash surrender value may have a tax consequence. Extended term maintains the same base amount. Reduced paid up provides coverage for the rest of the insured's life. Dividend options. Dividends are never guaranteed. They're paid to policy holders of a mutual company. They're cash. Apply to reduce premiums. Accumulation at interest. Paid up additions. Paid up option. 1 year term. Settlement options. Lump sum is not an option. It is the default mode of the settlement. They're interest only. They have a fixed period and a period certain. A fixed amount and an amount certain. Life income, life only, and straight life. Life income with period and an amount certain. Joint and survivor, joint life, and joint and last survivor are all examples. Riders. Possible riders are a waiver of premium, accelerated death benefit or living needs, guaranteed insurability, cost of living, accidental death benefit, also known as double indemnity, and payer benefit rider. Other provisions. Absolute assignment or collateral assignment. Viatical settlement, life settlement is an example of an absolute assignment situation. Loan or withdraws. Grace, there's nothing on that one. I think it's just saying you can take loans or withdrawals out of whole life usually. Grace period is usually 30 to 31 days in life. Lapse reinstatement. A policy may be reinstated for up to 3 years by submitting an application, past due premium, interest, and medical exam. Automatic premium alone pays the premium at the end of the grace period. Succession of beneficiaries goes primary, then secondary or contingent, then tertiary is the third. Uniform Simulation Death Act, Short-Term Survivorship, Common Disaster Clause, protects the rights of the secondary beneficiary in the event the insured and the primary beneficiary die as a result of the same accident within 90 days of the same accident. Class designations. For insureds that have multiple beneficiaries, per capita, immediate children only, per stirpes, may pay through gaps in the family tree. Annuities. There are fixed, indexed, and variable annuities. There's an accumulation period, which is paying in the single premium, flexible premium, paying in either the single premium or the flexible premium, and they have tax deferred growth. The annuity period is the period of taking out. It could be immediate or deferred. Periodic payments start after one payment period within 1 year. They are not designated to pay a lump sum. Gains are taxable per exclusion ratio. So while they're growing, they're tax deferred, and then when you're taking them out, they're taxed based on an exclusion ratio. They're basically a tax deferred savings account with an insurance company. The exclusion ratio is the amount invested or the expected return. The amount invested divided by the expected return, I think. Fixed annuities. No securities license is required. Money is invested in a general account. Annuitant is guaranteed minimum interest rates. Equity indexed annuities and indexed annuities. Life insurance license only is required. Growth mimics a stock market index. S&P 500 is the most common. Insurance companies guarantee a minimum interest rate, and different crediting strategies may be used. Variable annuities. You must have a security license and a life license. Money is placed in the separate account. The owner chooses the investments during the accumulation period. They have tax deferred growth and purchase accumulation units. They have no guarantee of return. During the annuity period, the owner chooses a settlement option. Accumulation units are converted to annuity units. Although taking payments, the number of annuity units remains constant. Payments are based on an exclusion ratio. So under general account, you have whole life, universal life, and fixed annuities. Under separate accounts, you have variable life, variable universal life, and variable annuities. So it's easy to remember that you have a separate account for things that have variables and a general account for the fixed, universal, and whole. Qualified plans. Tax deductible contributions and taxable distributions. 401k equals elective salary deferral for profit companies. 403b is an elective salary deferral for nonprofit companies, such as churches, schools, or hospitals. ESOP equals receive stock in the company you work for. Profit sharing equals share in the success of the company. Regular IRA equals earned income. Keogh SEP equals self-employed. Simple IRA equals small corporation, no more than 100 employees. After tax contributions and tax-free distributions, 429 plan CESA equals savings plan for higher education. Both or Roth IRA equals earned income. Health insurance policies. Basic medical, first dollar coverage, no deductible, very limited. Major medical, deductible, co-insurance, stop loss. Cost sharing, deductibles and co-insurance are part of cost sharing. Supplemental major medical may be purchased to supplement a basic medical plan. Comprehensive medical, corridor deductible, combines a basic and major medical on one plan. Blue Cross, hospital care and service plan. Blue Shield, medical care, doctor, and service plan. Multiple employer trust, or MET, legal entity for employers to join to receive better rates for group plans. Self-funded plan, stop loss contract. High deductible group health plans, contract with a TPA or ASO to administer the plan. Health maintenance organizations, or HMO. Capitalization, primary care physician gatekeeper, preventative care, copay, group practice model, independent practicing physicians, staff model, most restrictive, and confined to a service area. Under preferred provider organization, or PPO, we have specialty physicians, cheaper to choose a doctor that's in network than out of network. Cafeteria plans, we have specified disease / dread disease policy, cancer policy, which is most common, heart disease, critical illness policy, hospital confinement, income or indemnity policy. Franchise plan, treated as an individual policy except for premium rate discrimination. Blanket policy, covers a geographical area, no names are on it. Social Security equals OASDI. That was the original name for it. Benefits provided are retirement, survivors, disability income, and Medicare. Eligibility requires fully insured status, which is 40 calendar quarters or credits. Currently insured status, which is 6 quarters out of a 13 quarter period. Partially insured status, which is 20 calendar units or credits out of a 40 quarter period. Those are the different categories of eligibility. Retirement benefits at 62 years of age equals 80% benefit. 65 or 67, depending on the year you were born, you'll be fully eligible. Or 60 years of age if you're a widower. Survivor benefits include a lump sum of $255 for burial. Income for your surviving spouse with minor children. And the blackout period begins when the youngest child turns 16, and it ends when the surviving spouse turns 60. Disability benefits. Most restrictive definition of a disability. Cannot perform any substantial gainful work activity due to mental or physical disability. Expected to last at least 12 months or end in death. and has a 5-month waiting period before benefits begin in the 6th full month of disability. Eligibility for Medicare benefits. You need to be 65 and over to earn it. 65 and over have not earned it but are willing to pay the premium. Social Security disabled for 24 months. So you can either be 65 and over and have earned it, or 65 and over and have not earned it but are willing to pay the premium, or are on Social Security and disabled for 24 months. And you'll be eligible for Medicare benefits. Medicare plans break down into 4 parts. Part A is hospital, Part B is medical, Part C is Medicare Advantage. So these are private insurers offering service plans such as an HMO or PPO. And Part D is prescription drugs. Medicare supplements are sold by private insurers to fill gaps that Medicare leaves behind. There are plans A through N. Insurers must offer at least the core plan, which is Plan A, and there's a 30-day free look period. Medicaid is for low income, and the medically needy, medically indigent. 24-hour coverage, workers' compensation for on-the-job losses, which provides medical, disability, income, death, and rehabilitation. Health and disability coverage off the job, and must complete an 8-hour course on workers' compensation, employer's liability. I guess in order to sell it. I'm not sure what that part is. Disability income, must have a job and earned income. The cause of the disability may be intentional or unintentional. The result must be accidental to be covered. So whether what you did was intentional or unintentional, the result had to have been accidental. Definitions of disability. Total disability is own occupation, liberal definition, and expensive. Total disability, any occupation, is restrictive definition and cheaper. Total disability, Social Security disability, is the most restrictive definition. Presumptive disability is the loss of sight, hearing, speech, or any 2 limbs. The policy will pay the full benefit even if you find another job. Permanent disability is for the remainder of one's life. Temporary disability is an expectance that they'll recover. Partial disability is part-time. Residual disability cannot earn as much, is when the person cannot earn as much. And reoccurrent disability is a relapse. Elimination period is the time in which no benefits are paid at the beginning. Regarding taxation, if the employer pays the premium, the benefits are taxable to the employee. If the employee pays the premium, the benefits will be tax-free to the employee. Regarding the taxation of group health coverage, the employer has tax-deductible premium and the employee receives tax-free benefits. Long-term care does not include acute care, is not for low income, not for high income. Policies of types offered. Types of policies offered. Individual policy, group contract, or rider can be added to a life insurance policy. Institutional care is a nursing home. Home care is home care or community-based care. Comprehensive care includes institutional care and home care on one plan. The home care must pay at least 50% of the nursing home benefit. 3 levels of care are skilled nursing care, which is 24 hours a day in a facility, intermediate care, which is occasional nursing and rehab care, and custodial care, which is care by family members or unskilled care. Plans offered are tax qualified, federally regulated, more restrictive. There's 6 ADLs. That's on the tax qualified ones, which are federally regulated and more restrictive. The non-tax qualified are state regulated and are less restrictive, and they include 7 ADLs. Triggers for benefits. A person cannot perform 2 ADLs, which are activities of daily living. And some of those include the inability to think, reason, or remember, such as Alzheimer's. Types of care. Adult daycare. You drop your parents off at a daycare center so you can go to work and earn a living. Hospice care, which is designed for terminally ill, no rehabilitation. Respite care, where you give the daily caregiver a break. Personal care, which is also called custodial care, assists with eating, bathing, dressing, going to and from the toilet. Homemaker services include cooking and cleaning. Home health visits are occasional visits from a home health aide. And there's a 30-day free look period. Legislature regarding health coverage. Major Risk Medical Insurance Program, which is MRMIP. California state program funded by tobacco taxes. There's a waiting list based on the date the complete application is received. There's an annual deductible of $500 with an out-of-pocket maximum of $2,500. There's a maximum lifetime benefit cap of $750,000 per member. Eligibility guidelines: they must be a California resident and not eligible for Medicare Part A and B, and not eligible for COBRA or CalCOBRA, or have a pre-existing condition denial letter within the past 12 months. Patient Protection and Affordable Care Act, PPACA. Children are covered until the age of 26. No pre-existing condition exclusions for children up to the age of 19. The metal plans are platinum, which covers 90%, gold, which covers 80%, silver, which covers 70%, and bronze, which covers 60%. California Health Benefits Exchange. Starting in 2014, individuals and small groups can compare plans and buy health coverage in a private market. The Federal Care Reform Act makes tax credits and subsidies available to Californians with income levels between 133% and 400% of the federal poverty level. It's in place to make sure that health insurance premiums are spent on healthcare costs and are not consumed on administrative costs and benefits. In large groups, 101 lives or more, insurers that spend less than 85% of premium reserves, or in small groups up to 100 lives, insurers that spend less than 80% of premium revenues on clinical services and activities to improve healthcare quality must provide a rebate to enrollees. Pre-existing conditions insurance plan, PCIP. Federal version of the MRMIP. Temporary program ends on December 31st, 2014 and has been extended. Premiums are less than MRMIP. Does not cover dependents 18 or over. They have to apply for themselves. No annual maximum benefit or lifetime maximum. After you enroll, there is no probationary period. Access to infants and mothers, or AIM, has low cost coverage for pregnant women. Healthy Families Program has low cost health, dental, and vision for children up to age 19 if parents do not have group coverage. Pregnancy Discrimination Act, or PDA. Any benefits afforded to short-term disabled employees must also be provided to pregnant women. Medical Loss Ratio, MLR. An overcharging by an insurance company must be returned to the subscriber. Americans with Disability Act. Alzheimer's is not a disability. Symptoms of obesity are Family Medical Leave Act, FMLA, is 12 weeks of unpaid leave per year or 0 weeks of paid leave. The unpaid leave is to take time off work to have a baby, take time off work to adopt a child, take time off work to assist a family member with long-term care needs, or to take time off for personal medical needs after using up your sick time and vacation time. Multiple Employer Welfare Arrangement, or MEWA, is for people who work 2 or more part-time jobs that do not qualify for benefits. Records to be kept. Life agents have to keep copies of applications, informal records, and financial records for 5 years. They have to keep policy replacements for 3 years, advertisements for 3 years, life and disability analyst agreements for 3 years, life insurance companies 5 years. Unfair trade practice. If it's unwillful, there's a fine of $5,000 per incident, and if it's willful, it's $10,000 per incident, and a cease and desist order will be issued. Violation of a cease and desist order, if it's unwillful, will be $5,000 per incident, and if it's willful, $55,000 per incident. And the license will be suspended for up to 1 year. If an agent engages in unnecessary replacement of policies, the first offense is $1,000, and subsequent offenses are anywhere from $5,000 to $50,000. Insurer violations, the first offense is $10,000, and subsequent offenses are between $30,000 and $300,000. Fraudulent claims result in a felony up to 5 years in prison, $150,000 fine, or double the value of the fraud, whichever is greater. Application for a license may be denied on the cause basis of a 5-year history with or without a hearing. Any administrative action, including expunged records, may be disclosed. If there's a change to your submitted application, changes must be made within 30 days. A license may be suspended or revoked for the same conditions. Immediate notification of any address change. Your license is good for 2 years. You have 1 year after to still renew with a 50% penalty fee. 90 days prior to the renewal date, you'll receive a notice from the Department of Insurance stating your required continuing education credits needed to renew and the renewal fee. As long as your renewal fee and continuing education is completed within the 2-year period, you may continue to transact for 60 days while waiting for the new license to be issued. Your license requires 24 hours of continuing education every 2 years. A 4-hour ethics course is required every licensing period as a part of your 24 required hours. If offering annuities, an 8-hour approved course must be completed as a part of your continuing education requirement initially, and then a 4-hour required annuity course will be required every licensing period from then on. If offering long-term care, an approved 8-hour course must be completed as a part of your continuing education requirement per licensing period. All licenses are active or inactive. Active means renewal fees are paid, continuing education is completed, and there is an appointment on file. Inactive means renewal fees are paid, continuing education is completed, but no appointment is on file. Solicitation prior to agent appointment. Company must appoint within 14 days. COBRA is a Consolidated Omnibus Budget Reconciliation Act. That's what it stands for. For employers that have 20 or more employees that offer group health coverage, continuation of benefits only. Sign up within 60 days of being notified. You have 18 months for termination or reduction in work hours. You have 36 months for death of an employee, dependent child, or if there's a divorce or a legal separation. Cal Cobra, same as federal COBRA, used for small employee groups, 2 to 19 employees. OBRA is a 1989 an act that extends minimum COBRA for certain qualified beneficiaries. 1990, when seniors sign up for Medicare Part B, they have a 6-month window to purchase a Medicare supplement policy without evidence of insurability. So that was an addition in 1990 to OBRA. COB, or coordination of benefits, keeps from overinsuring when married couples have group insurance with respective companies. Abbreviations for federal acts. ADA is Americans with Disabilities Act. AIM is Access to Infants and Mothers. ASO is Administrative Services Only. CCR is California Code of Regulations. CIC is California Insurance Code. COBRA is Consolidated Omnibus Budget Reconciliation Act. DI is Disability Income. ERISA, ERISA, is Employee Retirement Income Security Act. FMLA is Family Medical Leave. HICAP, HICAP, is Health Insurance Counseling and Advocacy Program. LTC is Long-Term Care. MEC or MEC is Modified Endowment Contract. MET or MET is Multiple Employer Trust. MIB is Medical Information Bureau. MLR is Medical Loss Ratio. MRMIP is Major Risk Medical Insurance Program. NAIC is National Association of Insurance Commissioners. OASDHI is Old Age Survivor Disability and Health Insurance. OBRA is Omnibus Budget Reconciliation Act. PCIP is Pre-Existing Conditions Insurance Plan. PDA is Pregnant Discrimination Act. PPACA is Patient Protection and Affordability Care Act. TAMRA is Technical and Miscellaneous Revenue Act. TEFRA is Tax Equity Fiscal Responsibility Act, and TPA is Third Party Administrator. End of Life and Health additional resources.